Hello, Sqwire peeps. This is our third or fourth webinar that we have, try to give you as much information as possible. And today we have a friend of mine, Halliley, who is up in New York area, who has ridiculous amounts of knowledge and wisdom when it comes to investing. So last two webinars, we did some boring stuff, but we got a lot of great information back from you guys, which we appreciate. So I figured we can throw in a little bit of fun, future, how to build your life and have an awesome wealthy outlook for you guys. So Casey, thanks a lot for coming on. I really appreciate it. How is it up in New York?
It's nice. It's beautiful. Absolutely gorgeous.
Yeah, we were just talking. It was supposed to rain today, but we're down in Virginia, and it's just nice, 80-some degrees and beautiful to look out. So we usually have people on Facebook that watch us, and then also through the Zoom link, and we record it. So there will be quite a few people. Just for everybody that's on there today, just know that questions are welcome and appreciated. Anything that Casey will be going over, if you want any more explanation or just to kind of for her to elaborate on, or make it simpler because she's ridiculously smart. That's my job. I'm the stupid one of the two. So just ask and I'll make it normal the way I understand it, because she's way up there when it comes to the intelligence, all this stuff. So again, questions are really welcome. We appreciate it. Casey, thanks a lot. Again, take it away. Tell us everything that we need to know when it comes to building your wealth and your future.
Okay. Hi, everybody. I'm Casey Halliley from Wealthology. I am the Chief Educating Officer, and at Wealthology, we're on a mission to provide outstanding financial literacy training to students and young professionals. Today, we're going to talk about Investing 101, which is a vast topic that we couldn't possibly cover in 20 or 30 minutes, but we're going to try. Impossible. I'm going to share my screen in a couple of minutes, and we're going to talk. I'll try and talk for 20-ish minutes and leave some time at the end for questions. But of course, if you have any questions at all, you can feel free to put them in the chat, and Daniel can talk them out to me, or we can absolutely get to them at the end. So let me share my screen.
And also all this stuff, just for you guys that know, if you are on the platform, anybody, all this information is going to be on there as well. So we're covering a lot of stuff that's on the platform, but we wanted to give you live education consistently. So.
Okay, can everybody see my screen?
Yeah.
Can you see my screen?
Yeah.
Little Wealthology tree. So here's what I'd like to cover today. I'd like to cover three very specific things. Number one, why you need to invest. I'm going to try to convince you very briefly about how important it is to invest. Number two, we're going to talk about where to invest. So the first decision you'll have to make is what financial institution you want to go to put your investments in. And then the last thing we're going to talk about is what type of account is right for you when you want to start investing. So let's just kick it off with why you need to invest. And so let's say for an example, you think that you could possibly save $3 a day, and you decide you can do that for maybe 40 years. So $3 a day is about $1,100, and over the course of 40 years, you would accumulate something like $43,800. So I want to look at three different scenarios to see what might happen if you did different and slightly subtly different things with that money. So if you took $3 a day every single day for over the course of 40 years, maybe like the age of 25 to 65, and you shoved them underneath your mattress, not surprisingly, you would end up with $43,800. If you took $3 a day and you transferred it from your checking account into your savings account, and maybe your savings account earned you 1% interest a year, you would end up accumulating something like $54,000. But let's say you decided instead to just transfer that money, instead of into your savings account, into an investment account that was earning something like 7% interest or growth. You would end up accumulating something like $240,000, close to $250,000, just by making that subtle shift, making that subtle different shift into investing instead of keeping that money in your savings account or under your mattress, which I do not recommend you do. And so we always use, just so you know, we always use a 7% rate of return on what we assume you can make in the stock market, because that's the long-term average over the past 100 years or so of what stocks have returned. So we use a 7% return, but just as a reminder, that's an assumption. As we all know, the stock market can be extremely volatile.
What do you tell to those people, just real quick, that say 10% is what you always need to use? I mean, I hear that often. I'm like, that's crazy on the aggressive side, but people believe that, right? It's just a belief. I use the same 7%.
It's okay to use 10% if it's all about risk and return. So if you take a lot of risk, you can and should expect to make a greater return. If you take a lot of risk, you also have to understand that you're taking risk that you could lose that amount of money as well. So I think a conservatively structured portfolio, relatively conservative, and some people use a 5% assumption. I've chosen to use a 7% throughout all of my courses because it is, again, it's the long-term average of what stocks have returned over the past century. And I believe that it is a reasonable estimation of what you can make over many, many years in the market.
I agree.
And it's just an assumption. So this is why how I'm trying to convince you how important it is to invest. In my mind, there is literally no better way or other way to really grow significant amounts of wealth, unless you have a rich auntie or an oil well in your backyard. You must invest if you really want to grow significant amounts of wealth. So there I am. That's my trying to convince you why it's important that you need to invest. But if you signed up for this webinar, you probably are already convinced that you want to invest. So I'm going to move on, just spend a couple of seconds on that. So let's move on to where you should invest. And so the first thing, like if you're convinced and you're thinking, okay, great, I want to invest, what do I do? What's the first step? And what I sometimes say to my students, and I've had 100% hand raising answering yes to this question, is, have you ever been to a supermarket? And everybody always says yes. And I think about investing institutions sort of like going to a supermarket. So if you're the type of person, let's just say, that likes to go to a supermarket and be able to buy their cat litter and their shampoo and their shovels all at the same time as buying their groceries, well, there is a certain type of financial institution that might suit you if that's the way that you like to invest. And let me explain what I mean. So this is just our local supermarket, Stop and Shop, but it's just one of those supermarkets where you can go and buy beach toys and all the generic supermarket things, frozen vegetables, cans, and butcher stuff and everything. And so there is an actual model, that's a financial institution model, that's actually called the supermarket model of banking. And you'll probably recognize a lot of these names: Citi, Wells Fargo, JP Morgan. They're on all of our street corners across the country and probably most of the world. And so these are commercial banks. This is a type of investment institution that if you chose to go to this, I'm going to show you 3 different types of investment institutions. This is the supermarket model. And what does that mean? It means that you can, in many cases, get your insurance under this umbrella. You can have your mortgage at the same institution. You can have your investments. You can have your checking account and your savings account all in the same place. And the idea of this is so that you could have, in theory, one person, a broker perhaps, that can help you navigate for all of your financial needs. And this is a little bit of an outdated model, to be honest with you, but it really started to come to fruition in the 90s or maybe even the 80s it might have started, and people really liked it. But it turns out that it doesn't really matter if you have your mortgage and your checking account at JP Morgan. It might help a little bit if you can transfer assets or make your payment, but it's not really that important to have all of your assets in one place. And some people are not comfortable with that. So let's say you're the type of person that doesn't need to have the polished store floors and the butcher behind the counter saying, hey, here are the special types of pork that we've got. We've got these lovely chops and this lovely loin and all these different types of pork. And the butcher is behind the counter trying to sell you different types of meat. And maybe that makes you a little bit uncomfortable because you're thinking, I know that chicken is healthier for me and it's cheaper. And I don't really get why this guy or woman is trying to sell me pork when I know that this other thing is better for me. And so if you start to feel that way about that type of model of having somebody that's there trying to sell you assets and sell you a mortgage and also maybe perhaps insurance, there's a different type of model. It's a bit more DIY. I like to call it the Costco model. And there are no polished floors, there are no shopping bags, there's no butcher behind the butcher counter telling you about different types of pork, there's no cheesemonger talking about stinky cheese. You just go in and you buy what you need and then you leave. And so the Costco model of investment institutions are, and by the way, these lists are not exhaustive in any way. Of course, there are many more commercial banks and there are lots of different these Costco model institutions. Above the line are called money managers, I guess I would call them, and below are discount brokers. There are tons of money managers, T. Rowe Price, lots of others. There's lots of discount brokers below the line. I've just listed a few so that you can be familiar with some of them. And so if this DIY model works for you a little bit better, over here on the left, you'll be paying much higher fees for all of the brick and mortar locations that are on every street corner, all of the brokers, the thousands of brokers that are out there selling assets and investment, investments, whatever, to all of these people. So the supermarket model is quite expensive, whereas the Costco model, the DIY model, is a little bit less expensive. You might not get the one-on-one hand-holding that you might get at the supermarket model, but the DIY model is a bit less expensive and they still have excellent customer service. And so the last model I want to talk about is what I like to call the Amazon Fresh model, which is like sitting on your couch in your pajamas, ordering your groceries in your pajamas and with your feet up on the coffee table, which is basically how I like to order my groceries. And the Amazon Fresh model is in the investment world are like these robo-advisors, which you may or may not have heard of. They're like robot advisors. These are computer algorithms that invest for you. There are no brokers. There are very few salaries to be paid. There are probably not a lot of brick and mortar buildings that they need to rent and so or own. So the fees are very, very low. So again, not exhaustive lists, but as you're thinking about what type of institution you may want to invest in, you might want to think about what your needs are. Do you want a lot of hand-holding? If so, maybe you want to be over there on the left at Citibank or Wells Fargo. Do you want really low fees? If so, perhaps you want to go over to Robinhood or Betterment or any one of the robo-advisors over there on the right. And I find that a lot of my students start over on the right and they want cheap and they want easy, and maybe they're younger, so they're more app-based or website-based. And then as their assets start to grow and their needs become a bit more sophisticated, they gravitate or towards the middle perhaps, or over towards the left as they get a bit older and they actually do need some hand-holding because they have all of this wealth that they've grown. And also, I just want to say one other thing about this slide is that there's a lot of movement between these types of institutions. The banks have smartened up and they've realized that people want robo-advisors. So they have robo-advisors that are cropping up, and they are starting up robo-advisors of their own. They're scooping up some of the discount brokers. So there's lots of movement between these organizations. And so just because the commercial banks are on the left and the robo-advisors are on the right, there's a lot of gray areas between them. And actually, I just want to say one more thing about this slide is that just like if you go to the supermarket and buy a 6-pack of Coca-Cola, let's say you go to Stop and Shop or whatever your local supermarket is, and then you go to, this is not a great example because I don't know if you can buy a 6-pack of Coca-Cola at Costco, but let's say you can, and you buy a 6-pack of Coca-Cola at Costco or at Amazon Fresh. Well, those assets, or let's say we're talking in the financial world, Coca-Cola stock, it is the exact same thing. So if you buy a 6-pack of Coca-Cola at Stop and Shop, in theory, you could probably return it to Amazon Fresh. And the way that that is translated in this supermarket analogy is that if you buy Coca-Cola stock or a portfolio of stocks at Citi, you can transfer them to Wells Fargo, to Fidelity, to TD Ameritrade, over to some of these robo-advisors. So all of these, once you have an account at one of these institutions, it doesn't mean that you're married to this institution for life. You can always transfer an account of investments over to different institutions if you're unhappy or if your needs change. So that is why, so that is where you may want to think about considering where you want to invest. That's the first stop on your investing journey, is where you should go. So let's move on to the last point I want to talk about, which is, if there's not any questions on the previous slide.
No, we're good for now.
Okay. So let's talk about what type of account you want. And this is really tricky because, so you find the institution that works for you. Great. Maybe it's Vanguard or Betterment or Citi. I don't know. And you find this institution and you're so excited. So you go to the institution either via telephone or digitally or on the app or on the website or in person or whatever it is. And the very first question they're going to ask you is, what type of account do you want to open? And I find a lot of my students are really, that's a huge obstacle for them. And I think that I put this, so this, for instance, if you click on open up a new account at Vanguard, this is what you see. And people say, but how am I supposed to understand what these are? How do I choose? And it's actually quite simple. So we're going to go through a really quick exercise about how you can choose what type of an account would work for you. And then I'm going to explain a few of the different characteristics of the different types of accounts, so you understand and you can be a bit more knowledgeable about the way that you go about opening up an account. So you pick your institution, and then you have to figure out what type of an account you want to open. So here's what we do. Here's the very, very short and easy exercise I like to do with students of mine to figure out whether or not what type of account works for them. I ask them this simple question: do you have access to a 401k? And if the answer to that question is yes, well then, that's how you should be investing. There's lots of reasons why that is. 401ks are automatic, so you're automatically investing. They're usually investing you in low fee and diverse funds, which is exactly how you should be investing, in my opinion. They are tax advantaged. We're going to talk a little bit about that on the next slide, or a lot more about that on the next slide. These accounts are protected for you in bankruptcy. That means that if you go bankrupt and you have $20 or $50 or $100,000 in a 401k, that money cannot be touched. It's protected for you in bankruptcy. These accounts are also locked up for you, which means that you can't get the money out until you retire without paying penalties. And that, in my mind, is also a good thing because it helps you accumulate wealth rather than spending it on other things. And so if the answer to this question is yes, I have access to a 401k, well then, your decision about how to invest is super easy. You walk into your HR manager's office, or maybe these days you call them up, and you say, I want to invest in or I want to start up my 401k, participate. The other lovely thing about 401ks that I almost missed is that the company that you work for sometimes will give you a company match, which is free money. So if you are thinking about investing and you are not participating in a 401k, match or no match, that should be your first stop in investing. If the answer to that question is no, that's very easy, I know. If the answer to that question is no, well then you can consider starting an IRA, which is called an individual retirement account. And you can put in, IRAs and 401ks are pretty identical. They're not identical in some, they are identical in some ways, and they are not in others. The ways that they are not is that obviously you can put up to $19,500 a year into your 401k this year. They change that every few years, they increase it. And this year you can only put up to $6,000 in an IRA. So there are different amounts that you could put in. 401ks are automatic. Your company will sign you up, and then every single pay period, you get money taken out straight into the investments. Don't have to think about it. Don't have to do anything. That doesn't happen with an IRA. And the other way IRAs are not the same as 401ks is that there's no possibility of getting a company match with an IRA. But otherwise, all of the other things that I mentioned are identical. They are locked up for you. They are protected in bankruptcy. They are tax advantaged. Those are all three really, really important things when you think about what type of an account you want to hold your investments in. So you may have seen on that Vanguard slide a word that sometimes people are confused about. It says rollover. So if it might say, would you like to roll over a 401k? And so I want to talk about that for just 2 seconds. The word rollover means that these two accounts are fungible, completely fungible. So if you have 3 or 4 old 401ks from an old job from old jobs that you had that are floating around out there in investment cyberspace, and an IRA at whatever city, let's say, you can roll all of your old 401ks into that IRA. If you have a bunch of IRAs, you can roll them into your one 401k. If you have a bunch of IRAs and 401ks, you can all mesh them together. A bunch of 401ks, put them into one. The point is that all of these accounts are fungible. They can all be consolidated as long as they are before tax. We're going to talk about that again in a second, but as long as they are before tax money. You never want to intermingle before tax money and after tax money. And you should always speak to your accountant before you consolidate accounts. But I just wanted to talk about rollover for a second because I do find sometimes people are overwhelmed when they see that word. It's actually quite simple. So we have these 2 accounts, and now we have this dotted line. And I mentioned that these accounts are tax advantaged. And what does that mean? It means that, well, above this line, these accounts are before tax. And that means you put money into these accounts before you pay taxes on them, income taxes, that is. You put money in before you pay income tax on them. The money sits in those accounts all that time, growing tax-free. So we're talking about 2 different types of tax here. Income tax, these accounts are before income tax, and then you pay income tax on them on your way out, when you take the money out in retirement. You pay income tax on them at your current income tax rate when you've retired. But all along that time, they grow tax-free. So these are 2 different types of tax. Income tax, you never ever get away from. You either pay it up front or you pay it on the way out, but you're never going to get away from that. But these accounts being tax advantaged means that you are not paying capital gains tax on the investments while they're in there and they're growing. That means if you buy something at 100 and it accumulates to 125 or 500, you don't owe capital gains tax on the growth of those investments. So income tax you're always going to pay either upfront or at the end, and you can basically choose that, which we'll talk about in a second. But tax advantaged accounts mean that you don't pay capital gains tax on the investment gains. You also can't take losses, but we're not going to go into that. I'm not an accountant. And so below the line is after tax. And what does that mean? So actually below the line is after tax and not tax advantaged. So I said, if you have access to a 401k, your first stop, it provides you with so many amazing benefits. But if you don't, or maybe you've already maxed out your 401k, which would be really awesome, you may be thinking about either a joint account or an individual account. A joint account is very simply an account that has more than one owner. Maybe it's you and a parent, or maybe you and a spouse, or you and a child, or you and a neighbor if you're very generous. And an individual account is an account that has only one owner. And I would imagine if you are starting to invest and you're new to it, and you have taken care of what's above the line there, most people will probably just start out with an individual account. But let me just explain these accounts in a little bit more detail, because there's one really beautiful, lovely, important account that I have missed out on, my favorite account. And so we're just going to bring back the dotted line again for a second. Above the line is before tax, and that's income tax. Below the line is after tax, after income tax. And so one of the ways that I like to just take this analogy and just wring it out really dry and kick it and stand on the counter and jump up and scream about it is, I like to take my analogies a little bit far, is it's like when you go to your supermarket and you walk in, you're not going to walk around the supermarket taking all of your groceries, are you? And holding them and shoving some in your shirt and down your pants or anything. You need to have a cart. And so when you go to the supermarket, you must pick the type of cart which in this analogy is like your account. You have to pick the type of account that works for you, pick the institution that works for you and meets your needs, and then pick the account that works for you. And there are lots of different kinds of accounts, but it doesn't have to be that complicated. Most of the ones on that Vanguard sheet are not really applicable to most of us. And so let's just look at the different types of carts again. So we have a shopping cart on the top, it's called the 401k, and a shopping cart on the top right, which is an IRA. These accounts, again, just to go over what's so wonderful about them, they are tax advantaged, so you're not paying capital gains tax on any of the gains on the investments inside of those carts. They are locked up for you, so you cannot touch that money. It is growing for you to build your wealth. They are, well, in some cases, 401ks investments are automatic. IRAs, sometimes they're not, but you can absolutely set them up that way. They are protected for you in bankruptcy. And the way that the income tax works when it's before tax is you put pre-tax money in, comes straight out of your paycheck perhaps, or if it's an IRA, you can deduct it, and then that money grows tax-free for you all along the way. And then you pay income tax on the way out. And so again, let's bring these other two carts that we talked about on the last slide back in. After tax money, so this is money that you pay taxes on, and then you might write a check from your checking account and put it into an individual or a joint account. And that's after tax money. It is not protected for you in bankruptcy. It is not locked up. You can access it whenever you want. It is not tax advantaged, so you're going to pay capital gains tax on all of the investment income you make, or gains and income you make, and that's it. So there was one more cart that I wanted to talk to you about, and show you, and that's called the Roth IRA cart, or Roth 401k. You could have all of the same, most of the same characteristics. And these carts, so the Roth IRA, you'll see, is under the dotted line, so it's after tax. So you put money in after you've paid income tax on it, grows tax-free all that time. It is protected for you in bankruptcy. It is not locked up, so it is, with some provisions, it's accessible to you. So really the Roth IRA, in my mind, gives you a lot of the best of both worlds of all of these different types of accounts. There are some income provisions on Roth IRAs, so you must speak to your accountant before you open one. But Roth IRAs are a really wonderful account tool if you are thinking about starting to try to invest. I would strongly encourage you to figure out whether or not you're eligible to open up a Roth IRA. So those are the three things that I wanted to, how are we doing on time? Not too bad. Those are the three things I wanted to talk to you about. Number one, why you need to invest. Why? Well, because of that little box on the right-hand side of your screen, $250,000 versus 43 or 54 grand. There is just simply no better way to grow your wealth. Where you should be investing, you can think of it like a supermarket. What are your needs? What's important to you? Fees, hand-holding, good customer service. What are all these things that are important to you? And pick an institution that works for you. And then lastly, this graphic with all of these different types of accounts, I hope that helps you figure out what type of account would work for you. Again, I would always recommend that you speak to an accountant before you open up one of these accounts to make sure it is the optimal account for you and your financial situation. That's all I've got for the three things that I want you to know about Investing 101. The next step, of course, are all the important and exciting things you put into the cart, which are your investments. Thank you very much for listening.
No, that was, Casey, that was awesome. I really like the analogies. I tell stories all the time and people make fun of me for them. So at least I'm not the only one.
I love a good analogy.
Amazon garden and crap, which is fantastic. You know, it's funny when we talk about this stuff, you pretty much hit all the same points. One of the biggest things I always talk about is, if you know, how much money would you have to save at 25, 35, 45, and 55 in order to have $1 million? And it's amazing to see the difference in the numbers because of how early you start, or how big a difference is. I think it's like $300 at 25. I think it's like almost $800 a month at 45, 35. it's $1,800 at 45 and like all the money at 55 because you have no more time left. And people don't understand that, you know, whenever it comes to money, you have three variables, right? You have the amount of money that you can save, you have the amount of rate of return that you can chase, and you have the amount of time that you got left.
Yes.
And you can always save more, you can chase more, but you cannot take back time.
No.
So, you know, when we talk to the people that are graduating college, that are starting new jobs, and that little 401k just to check it off and go, yes, you get a 3% match, you should always do this. It's free money. Do the 3%. And then, you know, explore the other options. And like, just like you, I love the Roth option just because it's, you know, we're still at pretty historically low tax brackets. And, you know, with the money that we're spending with $2.3 trillion of stimulus money that we just got, somebody's going to have to pay that at some point.
Taxes are only going in one direction.
Right. Then it's amazing because the CPAs are like, oh, max out the 401k. And I'm like, you're in a 17% effective tax bracket. Like, would that potentially might not be the best thing for you to do? How about look at the Roth option as well? So you're not just, you know, looking at one thing. And that's what I try to teach. And you did the same thing. Is one thing never wins, because the one thing that's guaranteed is change. And your ability to deal with change is going to be success or failure, because it's never going to be all the same all the time. Market's going to go up and down. Taxes are going to go up and down. Liquidity needs are all along the way, your life. So, you know, when I see people, and I'm sure you do too, that have one thing, I'm like, you're just not preparing for the change that's guaranteed to come.
Yeah.
And it's
One
all
of the
the
other
stuff
things,
that you cover.
one of the other things I like to remind people is, if you have $1 million in a 401k when you retire, and you have $1 million in a Roth when you retire,
Yeah,
which
that $1
one's
million
worth
in a
more?
401k is not yours.
It's not all yours. That is, you still have a tax liability hanging over your head. So Roths are a wonderful option. If you're income eligible, there's a threshold to how much you can earn in order to participate in a Roth.
I do like, though, just like what you said, in a 401k, more and more companies are now participating in a Roth 401k as well.
Yeah.
So most places find out, if you are working at a company that has a 401k, a lot of times I'm seeing higher than 50% these days that have the option of the Roth and a traditional. So you can continue putting money in the Roth side. The match is going to have to go on the traditional side. That's just because of the rules. But it's getting to be more prevalent than it used to.
I agree. I see a lot of companies with 401k. Too.
Yep.
Yeah.
Well, thank you so much. Hopefully that was great.
Thank you for having me.
Next week, we'll see you same thing on Wednesday at 12:30. We'll cover a lot more information. Enjoy New York, and I'll talk to you soon. Thank you so much.
Thank you. Thanks, everybody.